For 5,000 years, the gold to silver ratio never crossed a certain threshold. Until now. Francis Hunt has identified a pattern forming across quarterly charts, a pattern that has only appeared twice in modern history. Both times, it triggered wealth transfers measured in trillions. But here is what most analysts have missed entirely. 60 to 70% of the world's silver does not come from silver mines. And when demand from one single technology sector collides with this reality, the mathematics become impossible to ignore. There exists a number that has guided merchants, emperors, and nations for over 5,000 years. It is not a stock price. It is not an interest rate. It is the gold to silver ratio. This single number tells observers how many ounces of silver it takes to purchase 1 ounce of gold. And for most of recorded human history, this number has remained remarkably stable. In ancient Egypt, the pharaohs maintained a ratio of 8 to 1. The Roman Empire operated its vast economy at 12 to 1. During the classical gold standard era, nations fixed this ratio at approximately 15 to 1. These were not arbitrary numbers. They reflected the natural occurrence of these metals in the Earth's crust, and the genuine costs required to extract them. But something changed, something that Francis Hunt, a technical analyst who has studied market patterns for decades, identified as a profound structural failure. In recent years, the gold to silver ratio climbed to 126. This means it required 126 ounces of silver to purchase a single ounce of gold. Hunt recognized immediately that this was not normal market behavior. This was a distortion of historic proportions. Never in 5,000 years of monetary history had the ratio remained above 100 for such an extended period. Hunt began asking a simple question. What force could push this ratio so far beyond its natural range? The answer, he discovered, points to a fundamental change in how markets operate. Beginning in the 1970s, financial systems underwent a transformation. Paper contracts began replacing physical metal in price discovery. Futures markets allowed traders to buy and sell silver that existed only on paper. Derivatives multiplied the volume of silver traded far beyond actual physical supply. Hunt observed that this financialization created a disconnect between the price shown on trading screens and the reality of physical metal availability. Large institutions accumulated above-ground silver inventories. They used these stockpiles strategically, releasing metal into the market whenever prices attempted to rise. This suppression mechanism worked for decades. It kept silver artificially cheap compared to gold, discouraged investment in new silver mining operations, and it created a false sense of abundance in a market that was slowly depleting its reserves. But Hunt noticed something on his charts that changed everything. The ratio broke below 65. This level had served as critical support for years. When it failed, Hunt identified a massive technical pattern completing its formation, a head and shoulders reversal, spanning not months, but years. This pattern appears rarely on quarterly charts. When it does appear, it signals that a major trend is ending. Hunt calls the current phase the contagion stage. This is when momentum begins building beneath the surface. Technical signals start aligning across multiple timeframes, and prices prepare to move faster than most observers expect. For entrepreneurs and business leaders, this analysis carries significance beyond precious metals investment. The gold to silver ratio functions as an early warning system. When this ratio moves to extremes, it often precedes broader monetary stress. Hunt's research suggests that the decades-long suppression mechanism is breaking down. The inventory advantage that enabled price control is disappearing. The paper derivatives that disconnected prices from physical reality are losing their effectiveness. And the technical patterns that have guided markets for generations are now pointing toward a violent correction. Hunt does not view this as speculation. He views it as mathematics. When a ratio deviates this far from historical norms, it does not stay there permanently. It reverts. And when that reversion begins after decades of suppression, it does not unfold gradually. It unfolds with force. The question facing business strategists today is not whether this correction will occur. The technical evidence suggests it has already begun. The question is, what happens next? When the supply side of this equation reveals problems that most analysts have completely overlooked, consider a factory that produces automobiles. Now imagine that 60 to 70% of its tires come not from tire manufacturers, but as leftover material from furniture factories. This arrangement would seem absurd for any critical industry. Yet this is precisely how the global silver supply operates, and almost nobody talks about it. Francis Hunt uncovered a structural vulnerability in the silver market that most analysts have either ignored or misunderstood entirely. He discovered that the majority of the world's silver does not come from silver mines. It arrives as an accident, a byproduct, a secondary output from operations digging for completely different metals. When miners extract copper from the earth, silver sometimes appears alongside it. When zinc operations process their ore, silver emerges as a bonus. Lead mines produce silver as a side effect. Gold operations occasionally recover silver from their waste material. Hunt calculated that only 30 to 40% of global silver supply comes from companies whose primary mission is extracting silver. The remaining 60 to 70% comes from miners who frankly do not care about silver at all. This creates a problem that traditional economics cannot solve. When the price of copper rises, copper miners dig faster. They invest in new equipment. They open new mines. Supply increases to meet demand. This is how markets are supposed to function. But silver does not work this way. When silver prices rise, the copper miner does not suddenly dig faster. He is there for copper. The zinc operator does not expand production because silver reached new highs. He is there for zinc. The silver that emerges from their operations is simply whatever happens to come out of the ground. No more, no less. Hunt recognized that this supply structure is catastrophically inelastic. Rising prices cannot stimulate meaningful production increases. The market's primary tool for balancing supply and demand simply does not function. But the problem extends even deeper. For decades, artificially suppressed silver prices made dedicated silver mining economically unviable. Extracting silver from the earth requires enormous energy inputs. Processing silver ore demands sophisticated and expensive equipment. Developing a new silver mine requires years of exploration, billions in capital investment, and regulatory approvals that can take a decade to obtain. When silver traded at $20 per ounce, or even $30, the mathematics did not work for most mining projects. Companies could not justify the investment. Banks refused to finance new operations. Engineers and geologists moved to more profitable sectors. The result was systematic underinvestment, spanning not years, but decades. Hunt observed that the silver mining industry has been starved of capital, precisely when it needed investment most. Meanwhile, the above-ground stockpiles that enabled price suppression have been quietly depleting. Hunt pointed to data showing inventory drawdowns accelerating year after year. The silver that once sat in vaults, available to flood the market whenever prices rose too quickly, has been consumed. Industrial users have absorbed it. Investment demand has claimed significant portions. And increasingly, nations have restricted exports of strategic metals from within their borders. Hunt made a simple observation that carries profound implications. If you do not hold physical metal within your own country's borders, you do not truly have it. The inventory advantage that suppressed prices for generations is evaporating for business leaders dependent on silver inputs. This analysis reveals serious supply chain vulnerabilities. Manufacturers who assumed silver would always be available at stable prices may soon face a different reality. Technology companies planning product launches years into the future may discover their cost projections were dangerously optimistic. Infrastructure developers incorporating silver-dependent technologies may encounter procurement challenges they never anticipated. Hunt's assessment suggests the silver market is approaching a breaking point. Supply cannot respond to rising demand. Inventories cannot continue absorbing the shortfall, and the mining industry cannot rebuild capacity quickly, even if prices rise dramatically. The architecture of global silver supply contains structural cracks that have been forming for decades. Those cracks are now becoming visible, but the true scale of the problem only becomes clear when one examines what is happening on the demand side of this equation. A storm does not form from a single cloud. It forms when multiple weather systems collide at the same moment, in the same location, with nowhere else to go. Francis Hunt identified exactly this phenomenon unfolding in the silver market. Not one demand source growing, but 5, 6, 7 major industries, all accelerating toward the same finite resource at the same time. The first collision comes from above. Solar panels have transformed from environmental curiosity to global infrastructure priority. Every solar installation on every rooftop in every country requires silver, not as an optional component, as an irreplaceable one. Silver paste forms the electrical pathways that capture sunlight and convert it to power. No other metal conducts electricity with the same efficiency at the required temperature ranges. Scientists have searched for substitutes for decades. They have found none that work at commercial scale. Hunt examined the installation projections from energy agencies worldwide. The numbers show exponential growth curves extending into the next decade. Each percentage point of growth translates to millions of additional ounces required annually. The solar industry alone could consume more silver than currently exists in accessible inventory. But solar is only the beginning. The second collision arrives on 4 wheels. Electric vehicles have transitioned from luxury experiments to government-mandated transportation futures. Every electric motor contains silver. Every charging system requires silver contacts. Every battery management system depends on silver's conductivity. As nations announce bans on internal combustion engines, automobile manufacturers have committed to electrification timelines that assume silver will simply be available. Hunt noted that these projections rarely account for material constraints. Executives plan production targets without questioning whether the earth can supply what they need. but the true disruption has not yet arrived. Hunt focused his analysis on a technology that most investors have overlooked entirely: solid-state batteries. These next-generation power storage systems solve problems that have plagued electric vehicles for years. They charge faster, they store more energy, they operate safely across wider temperature ranges. They can power a vehicle for 900 kilometers and recharge to 80% capacity in just 8 minutes. Automobile manufacturers view solid-state batteries as the future of transportation. Investment has poured into research facilities worldwide. Commercial deployment timelines have accelerated. But Hunt discovered something in the technical specifications that changes everything. Solid-state batteries require massive quantities of silver. Not modest amounts, massive amounts. Hunt calculated that if just 20% of the battery market transitions to solid-state technology, it would consume 100% of current annual silver production, every ounce. For batteries alone, this leaves nothing for solar panels, nothing for electric vehicle components, nothing for the industries that already depend on silver today. Hunt listed them methodically. Smartphones require silver in their circuits. Computers depend on silver connections. Medical devices use silver for its antibacterial properties and conductivity. Military systems incorporate silver in guidance technology and communication equipment. Fifth-generation wireless networks require silver at every node. Smart grid infrastructure cannot function without silver components. Water purification systems use silver. Mirrors require silver. Photography still consumes silver. And investment demand from individuals and institutions seeking protection from monetary instability continues growing year after year. Hunt presented the mathematics plainly. Current silver production totals approximately 800 million ounces annually. Current industrial and investment demand already exceeds production. Deficits have been covered by drawing down existing inventories. Now, add solid-state batteries requiring potentially all current production. Add accelerating solar installations. Add expanding electric vehicle manufacturing. Add growing electronics demand from emerging economies. Add military applications that receive priority allocation regardless of price. The equation becomes impossible. Demand projections suggest requirements of 2 billion ounces, 3 billion ounces, perhaps more. Supply cannot reach 1 billion through any realistic expansion scenario. Hunt arrived at an uncomfortable conclusion. When physical supply cannot satisfy physical demand, only one mechanism remains: price. Price must rise high enough to destroy demand. Some industries will be priced out entirely. Some applications will become economically unviable. Some technologies will be redesigned or abandoned. This rationing through price is not a possibility Hunt identified. It is a mathematical certainty. The only remaining questions involve timing, magnitude, and what such price levels would mean for those positioned correctly, and those who ignored the warning signs. Every generation witnesses a moment when the rules of wealth quietly rewrite themselves. Most people recognize these moments only in hindsight. They look back years later and say, "I should have seen it coming." Francis Hunt believes this generation is living through exactly such a moment, and the evidence suggests most people are not paying attention. Hunt addressed the question that haunts every observer of this market. Is it too late? Has the opportunity already passed? His response reframes the entire discussion. If silver is traveling toward $1,000 or $1,200, does $82 represent an expensive entry point? The mathematics answer themselves. Hunt observed that people fixate on where prices have been, rather than where structural forces are pushing them. They see silver at current levels and remember when it traded at $15. They feel they have missed the move. But Hunt's analysis suggests the move has barely begun. He presented his technical framework with precision. The initial target sits at $333. This level represents not a final destination, but a resting point, a consolidation zone where momentum pauses before continuing. Hunt emphasized that $333 is not the high. It is where the market catches its breath. Before the next acceleration begins, beyond that consolidation, Hunt's projections extend into territory that seems impossible today: 4-digit silver, $1,000, $1,500, perhaps $2,000, in what he carefully describes as old money terms. But Hunt introduced a concept that separates informed observers from the crowd: the law of the parabola. This mathematical principle governs exponential price movements. It states that in parabolic advances, the majority of gains occur in the final phase. Not the early phase, not the middle phase, the final phase. Hunt calculated that 50% of all profits arrive in the last 5 to 10% of the move. Half of everything, compressed into the final stretch. This creates a psychological trap that destroys most participants. They watch prices rise from 50 to 100. They feel satisfied. They watch prices climb from 100 to 200. They feel nervous. They watch a pullback from 200 to 170, and they sell. They believe they have captured substantial gains. Then they watch from the sidelines as silver continues to 500 to 800, to levels they never imagined possible. Hunt has witnessed this pattern destroy wealth in previous cycles. He is attempting to prepare observers for what discipline will be required. The exit strategy Hunt recommends does not rely on price targets. It relies on the same indicator that signaled the entry, the gold to silver ratio. When this ratio collapses into single digits, when it approaches the historical norms that governed 5,000 years of commerce, that signal indicates the final phase is approaching. Hunt recommends partial exits only, approximately 50% of positions, to remove emotional pressure and secure guaranteed returns. The remaining 50% continues riding the wave wherever it travels. This is not speculation. This is professional risk management. But Hunt said something during his analysis that extends far beyond precious metals. He admitted uncertainty about what money itself will mean when silver reaches 4-digit valuations. He questioned whether the dollar will still exist in its current form, whether digital currencies will have replaced physical cash, whether the entire monetary architecture will have transformed. 4-digit silver does not occur in healthy monetary systems. It occurs when confidence in paper currencies deteriorates, when decades of monetary expansion reach their terminal phase, when populations seek tangible assets because intangible promises have lost credibility. Hunt is not merely predicting silver prices. He is describing symptoms of systemic monetary transition. For entrepreneurs and business leaders, this analysis demands serious consideration. Treasury management strategies may require reassessment. Supply chains dependent on silver inputs may need hedging. Balance sheet diversification may deserve higher priority. These are not investment recommendations. They are risk management observations. The structural forces Hunt identified, the ratio anomaly, the supply architecture, the demand convergence, are not speculative theories. They are documented realities. The train Hunt describes has left the station. It is accelerating. The question is not whether passengers should have boarded earlier. The question is whether observers will recognize that the destination has not yet been reached. History does not repeat precisely, but it echoes. And those who study its patterns position themselves before the echoes become obvious to everyone else. Francis Hunt has presented the roadmap. The mathematics have been calculated. The structural forces have been identified. What remains is the decision each observer must make alone.